The greatest transfers of wealth do not happen in times of peace and prosperity. They don't happen when the headlines are glowing, when the market is hitting all-time highs, and when every analyst on television is telling you it's a can't-miss opportunity. By the time the good news arrives, the opportunity is already gone. The price of admission has been bid up so high by the cheering crowd that your potential for extraordinary returns has evaporated. You are, at that point, simply providing the exit liquidity for the people who understood the real secret. The secret is that the fortunes of a lifetime, the kind of portfolio growth that leads to true financial freedom, are seated in moments of maximum pessimism. They are born in the quiet panic of a market sell-off, nurtured in the shadow of a terrifying headline, and harvested only by those with the courage to buy a wonderful business when it is temporarily under a dark cloud. Warren Buffett didn't build his empire by following the consensus. He built it by systematically and ruthlessly exploiting the gap between public perception and underlying reality. He mastered the art of being greedy when others are fearful. This isn't just a clever saying. It is the foundational principle of a trading strategy that has compounded capital at a rate that defies financial gravity. It is the core of a philosophy that turns market psychology on its head, transforming the average retail investor's greatest weakness, fear, into the professional's greatest advantage. You are here because you suspect there's a better way than buying high and hoping to sell higher. You are tired of feeling like you're the last one to the party, buying a stock only to see it stall or tumble. What you are about to learn is the blueprint for arriving before the party even starts. It is the methodology for finding and acquiring pieces of elite American businesses at prices that the fearful, the panicked, and the short-sighted are practically giving away. This is not about complex charts or algorithmic trading. This is about rewiring your brain to see value where others see only risk. It is a masterclass in contrarian investing, a deep dive into the practical application of value investing when it matters most. We will deconstruct this principle into 5 essential pillars, each one a load-bearing wall in the fortress of wealth Buffett has constructed. We will move from the anatomy of market fear itself to the calm, rational process of identifying greatness amidst the noise. We will quantify the staggering cost of waiting for a cheery consensus, and we will build the mental fortitude required to act decisively when every instinct is screaming at you to run for cover. By the end of this journey, you will no longer be a passive consumer of financial news. You will be an active and discerning hunter of opportunity, equipped with the stock analysis framework to turn the market's deepest anxieties into your greatest capital gains. This is the final promise of value investing. You do not need the market to be calm to succeed. You only need to be. The first pillar of this entire philosophy, the very bedrock upon which all contrarian investing is built, is the deep and unflinching understanding of fear itself, not just acknowledging it, but dissecting it, mapping its anatomy, and recognizing how it functions as a powerful yet temporary fog that obscures the true value of a great enterprise. To master this, we must travel back in time, not to a stock market crash, but to a bizarre agricultural and financial scandal that threatened to bring down one of the most trusted brands in the world. It was the early 1960s, a time of relative optimism, but under the surface of the financial markets, a storm was brewing. This storm was centered on a man named Anthony Tino DeAngelis and his company, Allied Crude Vegetable Oil Refining Corporation, in Bayonne, New Jersey. The story that unfolded became known as the Salad Oil Scandal, and for a young Warren Buffett, it would become one of the most profitable and formative case studies of his career. Allied Crude was in the business of exporting vegetable oils. Tino DeAngelis discovered a loophole that allowed him to secure massive loans using his inventory of salad oil as collateral. He would get warehouse receipts certifying he had a certain amount of oil, take those receipts to a bank or financial institution, and get a loan. The problem was, DeAngelis was a con artist on a grand scale. His massive storage tanks, supposedly brimming with valuable salad oil, were mostly filled with water. A thin layer of oil floated on top, fooling the inspectors. He had created a phantom inventory, securing hundreds of millions of dollars in loans against oil that didn't exist. One of his biggest lenders, a subsidiary of the American Express Company, was on the hook for a staggering amount. When the fraud was finally uncovered in November 1963, Allied crude collapsed overnight, defaulting on over $175 million in loans, an astronomical sum at the time. The market was thrown into a state of absolute panic. The name at the center of the storm was American Express. Here was a company whose entire business model was built on a single, intangible asset: trust. The iconic traveler's checks, the charge card, it all worked because people believed in the unwavering financial integrity of American Express. Suddenly, news broke that a subsidiary had been duped in one of the biggest frauds in history. They were facing potential losses that could, in the minds of many investors, bankrupt the entire corporation. The headlines were brutal. Wall Street was in a frenzy. The narrative was simple and terrifying. American Express is finished. The trust is broken. The stock, which had been trading at over $60 a share, plummeted. In a matter of weeks, it was trading in the mid-30s. The fear was palpable. Analysts, pundits, and the general public concluded that the damage to the brand's reputation was fatal. This, right here, is the anatomy of the perfect storm for a contrarian investor. You have a fundamentally great company, a household name with a powerful, entrenched business model, suddenly engulfed in a cloud of specific, horrifying, and easily understood bad news. While everyone else was selling, a 33-year-old Warren Buffett, running a small partnership in Omaha, did the opposite. He didn't just read the headlines. He went to work. He didn't guess. He didn't speculate on the sentiment. He began a meticulous process of stock analysis to answer one simple question: is the fear justified, or is it a massive overreaction? He traveled. He spoke to people. He went to restaurants and banks, observing whether people were still using their American Express cards and traveler's checks. He talked to vendors and asked if they were still accepting them. He was doing on-the-ground research, looking for evidence that the core business, the actual engine of profit, had been damaged. What he found was that the scandal, while a massive financial hit and an embarrassment, was contained. The public, by and large, still trusted the green card in their wallet. The traveler's checks were still seen as good as gold. The fear was concentrated on Wall Street, but on Main Street, the business was humming along. He concluded that the underlying business, the durable competitive advantage, was intact. The scandal was a massive but survivable one-time loss. The market, in its panic, was pricing the company as if its entire future was compromised. Buffett saw the disconnect. He famously committed 40% of his partnership's capital, a massive, company-betting move, to buying shares of American Express. He was buying when the stock was hated, when the news was terrible, and when the consensus was that he was insane. Over the next few years, as American Express dealt with the financial fallout and the market realized the core business was unharmed, the stock roared back. The position became one of the single greatest investments of his early career, turning a $12 million investment into a $20 million profit for his partners, cementing his reputation and providing the capital for future legendary deals. This story is the quintessential foundational anecdote because it perfectly illustrates the exploitation of fear. The market saw a fatal wound. Buffett saw a deep cut that would heal. The psychological engine driving the salad oil scandal panic, and countless market panics like it, is a powerful and primitive cognitive bias known as the availability heuristic, supercharged by herd behavior. The availability heuristic is a mental shortcut our brains use to judge the likelihood of an event based on how easily examples of it come to mind. When a dramatic, emotionally charged event occurs, it becomes incredibly available in our minds. The news of the American Express scandal wasn't just a data point. It was a shocking story of fraud, deceit, and potential ruin involving a famous company. It was splashed across the front pages of every newspaper. This vividness made the worst-case scenario, the complete collapse of American Express, feel not just possible, but probable. Investors weren't calmly calculating the potential loss as a percentage of the company's total assets. They were replaying the dramatic narrative of the scandal in their heads. This cognitive shortcut is an evolutionary feature, not a bug. For our ancestors on the savannah, If a tribe member was just eaten by a lion near a particular watering hole, the availability of that vivid, terrifying memory was a very useful tool for survival. It made you overestimate the risk of that watering hole and avoid it, even if, statistically, the risk was still low. In the modern world of stock picking and wealth management, however, this same mechanism is disastrous. The stock market is a constant fire hose of information, and our brains naturally latch on to the most recent, most dramatic, and most emotionally resonant stories. A scandal, a missed earnings report, a negative analyst downgrade. These things are far more available than the quiet, boring, and consistent cash flow generation of a company's underlying business over the past decade. The availability heuristic creates a distorted reality field around the affected stock. Investors begin to believe that the current crisis is the only thing that matters, forgetting the company's history, its balance sheet strength, and its long-term prospects. This is then amplified exponentially by herd behavior, also known as social proof. As the stock begins to fall, investors see others selling, which they interpret as a signal that the negative news is indeed catastrophic. The fear of being the last one out, of holding a worthless stock while everyone else got to safety, is an overwhelmingly powerful motivator. It triggers the amygdala, the primitive part of our brain responsible for the fight-or-flight response. Rational, long-term thinking, which is processed in the prefrontal cortex, gets short-circuited. You are no longer an investor making a calculated decision about capital allocation. You are a creature in a herd, stampeding away from a perceived predator. Warren Buffett's genius in the American Express situation was his ability to consciously override these two powerful psychological forces. He didn't allow the vividness of the scandal to dictate his perception of risk. Instead, he forced himself to seek out disconfirming evidence. He asked, "Is the story the market is telling itself actually true?" His on-the-ground research was a deliberate act of breaking away from the herd and gathering his own, less emotionally charged data. He was replacing the easily available, terrifying narrative with harder-to-acquire but far more relevant, factual information about consumer and vendor behavior. He was, in essence, insulating his prefrontal cortex from the panicked signals of the market's collective amygdala. Understanding this psychological dynamic is the first step toward becoming a successful contrarian investor. You must learn to recognize when your own brain is using the availability shortcut. When you see a stock plummeting on bad news, you must train yourself to pause and ask, "Am I reacting to the story or to the numbers? Am I feeling the herd's panic, or am I assessing the long-term impact on the business's ability to generate cash?" This is not easy. It requires a conscious and deliberate effort to step outside the emotional vortex of the market and engage in a different kind of thinking. It's about recognizing that the market's fear, driven by these cognitive biases, is precisely the force that creates the bargain price in the first place. You are not trying to eliminate the fear. You are trying to harness it as a signal that a potential opportunity for incredible portfolio growth may be at hand. So how does a retail investor, without the resources of a multi-million-dollar partnership, translate this into a practical, repeatable process? The blueprint for applying this pillar is something we can call the headline stress test. It is a mental model, a checklist you can run through every single time a company you admire or have on your watch list gets hit with what appears to be catastrophic news. Step 1 is to fully absorb the narrative of fear. Don't ignore it. Read the scary headlines, watch the panicked news reports, and understand exactly what the market is afraid of. Write it down in a single sentence. For American Express, it would have been, "The salad oil scandal will cause such massive financial and reputational damage that the company's core business of travelers' checks and cards will collapse." You must articulate the bear case clearly, because you cannot debunk a thesis you do not understand. Step 2 is to immediately separate the problem into one of two categories. Is this a temporary, survivable wound, or is this a permanent, fatal impairment to the business model? This is the most critical question in all of contrarian investing. A fatal impairment would be something like a new technology that renders a company's main product obsolete, or a change in regulation that permanently destroys its profitability. A temporary wound is a one-time event, even a very large one, that does not break the long-term cash-generating power of the business. An oil spill is a massive temporary problem for an energy company. A badly managed product launch is a temporary problem for a tech giant. The salad oil scandal was a huge, embarrassing, and costly temporary problem. To differentiate, you must focus on the company's durable competitive advantage, or what Buffett calls its moat. Ask yourself, has this bad news destroyed the company's moat? For American Express, the moat was the global network of merchants and customers built on trust. Buffett's research confirmed the moat was intact. For an entrepreneur running their own business, this is an invaluable lesson in risk management, knowing which threats are existential and which are merely expensive distractions. Step 3 is to engage in quantitative triage. This is where you put numbers to the fear. Open up the company's most recent annual and quarterly reports. Look at the balance sheet. How much cash do they have? How much debt? Look at the income statement. How much profit does the core business generate each year? Now, try to quantify the worst-case scenario from the bad news. For American Express, the potential losses were estimated to be around $60 million. While a huge number, a look at their financials would show that the company's earning power could absorb this loss over a few years without bankrupting the firm. The market was pricing in bankruptcy. The numbers were suggesting a very bad year or two. This disconnect between the narrative price and the quantitative reality is where the opportunity for massive capital gains is born. Step 4 is to invert the problem and look for second-order effects. Ask, what happens after the storm passes? Will the company be stronger? Sometimes, a crisis forces a company to clean up its operations, shed unprofitable divisions, and become more focused and efficient. Will competitors be weakened? A scandal can sometimes damage an entire industry's reputation, but the strongest brand often emerges with an even greater market share. This part of the trading strategy is about thinking beyond the immediate pain and toward the long-term competitive landscape. Step 5, and the final step in the headline stress test, is to set a price. Before you buy a single share, you must determine what you believe the business is worth in a normal environment, and then demand a significant discount for the current uncertainty. This is Buffett's famous margin of safety. If you believe American Express is worth $60 per share in a world without the scandal, you might decide to start buying only when it hits 35 or 30. This discipline prevents you from catching a falling knife too early and gives you the conviction to buy more if the price continues to drop, because you have done the work and know you are purchasing assets for far less than their intrinsic value. This systematic approach transforms you from a gambler reacting to headlines into a business analyst exploiting market psychology. To truly appreciate the power of this contrarian approach, we must dedicate time to exploring its antithesis, the path walked by 99% of market participants. This is the path of the emotional, consensus-driven retail investor who consistently buys high and sells low, ensuring a lifetime of mediocre returns and financial anxiety. Their journey begins not with analysis but with emotion, usually the fear of missing out, or FOMO. They see a stock that has been on a tear. The headlines are universally positive. Analysts on financial news networks are tripping over themselves to praise the company's visionary leadership and flawless execution. Their friends or coworkers are bragging about the money they've made on it. The cheery consensus is deafening. At this point, the availability heuristic is working in the opposite direction. The ease with which positive examples come to mind, the rising stock price, the glowing news reports, the anecdotal success stories, makes the investment feel completely risk-free. The thought of the stock going down is almost unimaginable. Driven by this social proof and a desperate desire not to be left behind, they finally decide to buy. They log into their brokerage account and purchase shares at or near the all-time high. They have just paid the absolute maximum price for that cheery consensus. For a short time, they might feel a sense of relief, even euphoria. They are finally part of the winning team. But then, the inevitable happens. The company, which seemed invincible, hits a snag. Perhaps it misses an earnings estimate by a few pennies. Perhaps a competitor launches a surprisingly good product. Or maybe a broader market correction, completely unrelated to the company itself, begins to drag all stocks down. The once glowing headlines turn cautious, then negative. The same analysts who were praising the stock are now expressing concerns. The stock begins to fall. At first, our investor is in denial. It's just a dip, they tell themselves. The company is great, it will bounce back. But the price continues to slide. 10% down becomes 20%. 20 becomes 30. Now the second, more powerful emotion takes over: panic. The availability heuristic kicks in again, but this time, the vivid images are of falling red numbers and scary headlines about a quote, plunging stock. The herd they so eagerly joined on the way up is now stampeding for the exit. The fear of losing everything, of seeing their investment go to zero, becomes all-consuming. They forget why they bought the company in the first place. All the long-term fundamentals are irrelevant. Their prefrontal cortex is shut down. Their amygdala is screaming, "Sell, get out now before it's too late," and so they do. They log back into their account and sell their shares for a significant loss, often near the very bottom of the decline. The feeling is one of painful relief, the kind you feel after escaping a near-death experience. They vow to be more careful next time. But then the cycle repeats. After the selling has exhausted itself, the company, if it is fundamentally sound, stabilizes and begins to recover. The bad news subsides. A few quarters later, it starts posting good results again. The stock begins its slow climb back. As it approaches its old highs, the positive headlines return. The analysts are back on TV, talking about the impressive turnaround. And our investor, having missed the entire recovery, watches from the sidelines, only to be tempted back in by the siren song of the cheery consensus once again. This cycle of buying at the peak of optimism and selling at the peak of pessimism is the single greatest destroyer of wealth for the average investor. It is the antithesis of everything Buffett practices. It is a trading strategy guaranteed to underperform, turning the powerful engine of compounding into a machine for churning capital and generating losses. The salad oil scandal is a perfect illustration. The 99% investor would have owned American Express at $60, sold it in a panic at $35, and then likely bought it back years later at over $100, having taken a huge loss and missed the entire multi-bagger return in between. They let the market's emotions dictate their actions, ensuring they were always on the wrong side of the trade. They did not have a process, only a reaction. They did not have a margin of safety, only a hope that the price would keep going up. This path is not just financially damaging, it is psychologically exhausting, creating a relationship with investing that is defined by fear, regret, and anxiety, rather than by confidence and long-term financial freedom. The direct financial connection between understanding fear and building wealth is profound and can be seen clearly on the balance sheet of your own portfolio. The impact is not theoretical, it is brutally quantitative. The core principle at play is the mathematical relationship between purchase price and potential return. Every dollar you overpay for an asset is a dollar of future return you have sacrificed. Conversely, every dollar of discount you receive on that same asset is a dollar of future return you have pre-loaded into your investment. When you buy a great company shrouded in fear, you are essentially getting future growth for free, or even being paid to take it. Let's use the American Express example with simplified numbers to illustrate this financial reality. Imagine two investors. Investor A represents the 99%. He buys American Express before the scandal at $60 per share. Investor B is the contrarian, who follows the Buffett model. He buys during the peak of the panic at $35 per share. Let's assume that a few years later, the company has recovered and its intrinsic value is recognized by the market, with the stock trading at $120. For investor A, his capital gain is $60 per share. 120 minus 60. He has doubled his money, a 100% return. This is a good outcome, and he feels smart for having held on. However, look at the financial reality for investor B. His capital gain is $85 per share, 120 minus 35. His return is not 100%, but over 240%. He has made significantly more money on the exact same company over the exact same time period. His only difference was his entry point. The fear in the market handed him an extra 140% of return. This is the tangible financial power of contrarian investing. It acts as a massive return accelerator. This concept is formalized in the idea of the margin of safety. When Buffett bought Amex at $35, he likely calculated its true, underlying business value to be at least $60 or $70 per share. That gap between price and value was his margin of safety. It provided two critical financial benefits. First, it offered downside protection. If he was wrong and the situation got worse, the stock could fall further, but because he bought it so cheaply, his risk of permanent capital loss was dramatically reduced. He had a buffer. The person who bought at 60 had no such buffer. Second, it provided massive upside potential. As the fear subsided and the price reverted to its intrinsic value, the closing of that price-value gap created a powerful tailwind for his investment. Separate from the actual growth of the business itself, he got paid for the business growing, and he got paid for the market's perception normalizing. This is a double dip of returns that is only available to the investor who buys during periods of stress. Furthermore, this approach directly impacts the long-term compounding rate of your entire portfolio. If you can consistently find opportunities to buy assets at 50 cents on the dollar, your wealth management strategy will not just outperform the market averages, it will obliterate them. A portfolio that compounds at 15% per year instead of 8% per year does not end up with just a little more money over a lifetime. It ends up with exponentially more. The difference over 30 or 40 years is the difference between a comfortable retirement and generational wealth. The fear of the crowd is, therefore, a tangible financial asset that you can acquire. When you see widespread panic, you should train your brain to see it as a fear discount being applied to the stock prices of good companies. Your job as a stock picker is to quantify that discount and determine if it's large enough to offer you both protection and outsized potential reward. By systematically doing this, you escape the trap of the 99% and begin to operate with the mindset of the 1%. You stop paying retail prices for your investments and start acquiring them at wholesale, all because you learned to run toward the smoke when everyone else was running away. The second pillar of Buffett's contrarian masterpiece is the ability to distinguish between a great company facing a temporary problem and a mediocre or broken company facing a terminal one. The market, in its panic, often fails to make this distinction. It sells everything associated with the bad news indiscriminately. This creates the opportunity. But the opportunity is only for those who can accurately assess the underlying quality of the business itself, completely divorced from the noise of the current crisis. The foundational anecdote for this pillar takes us to the early 1970s, a period of immense political turmoil in the United States. The Watergate scandal was consuming the nation, and at the center of the storm was one of America's most prestigious newspapers, the Washington Post. The Post, led by publisher Katharine Graham, was aggressively pursuing the Watergate story, a decision that put it in direct conflict with the Nixon administration. The political pressure was immense. The administration was openly hostile, threatening the company in various ways, including challenging the television licenses held by its parent company, Post-Newsweek. These licenses were incredibly valuable, the crown jewels of the company's profitability. The market looked at this situation and saw immense risk. The narrative was that the most powerful man in the world was at war with this newspaper company. Who would win that fight? On top of this political uncertainty, the entire newspaper industry was facing questions about its future. Competition was fierce, and costs were rising. In 1973, the Washington Post Company went public, and its stock performance was dismal. It languished, falling by nearly half in the subsequent market downturn. The consensus on Wall Street was that newspaper stocks were a bad bet, and the Washington Post in particular was a political time bomb. The cloud of bad news was thick and dark. It was a combination of industry-wide pessimism and company-specific political terror. This is precisely the kind of environment where Warren Buffett begins to get interested. He didn't see a political drama. He saw a business case study. He began to apply his rigorous stock analysis framework to the Washington Post company. What did he find? He found a business that was not just good, but truly extraordinary. He saw that in the city of Washington, D.C., the Washington Post had what amounted to a local monopoly on print advertising. If you were a department store, a grocery store, or any major retailer in the D.C. area and you wanted to reach the entire population, you had to advertise in the Post. There was no viable alternative. This gave the company incredible pricing power. It was an economic fortress, a toll bridge for local commerce. He looked past the Watergate headlines and analyzed the numbers. The company was gushing cash flow. Its television stations were also local monopolies, licensed to print money operations. He saw that the market was valuing the entire company at around $80 million. Buffett, through his analysis, believed the company's assets, if sold off individually, were worth at least $400 million, and likely much more. He was being offered the chance to buy $1 for 20 cents. The political risk, which was so terrifying to other investors, he viewed as temporary. He understood that the American system of government, with its checks and balances, was bigger than any one administration. The threats to the television licenses were likely just that, threats. He had faith in the durability of American institutions. More importantly, he had faith in the durability of the Post's business model. A consumer's habit of reading the Post every morning, and a business's need to advertise in it, were powerful forces that would persist long after the Watergate scandal was a chapter in history books. So in 1973, Buffett began buying shares of the Washington Post. He invested over $10 million, accumulating a massive stake. He famously developed a close friendship and advisory relationship with Katharine Graham. He was buying a newspaper stock at a time when the industry was unloved, and he was buying a specific newspaper that was at the center of a political firestorm. He was ignoring 2 layers of bad news to focus solely on the quality of the underlying business. The result? The investment became one of the cornerstones of Berkshire Hathaway's portfolio. Over the next 3 decades, that $10 million investment would grow to be worth over $1 billion, a 100-fold return. It is a stunning example of how focusing on business quality, especially when that quality is obscured by temporary, albeit dramatic, noise, is the key to unlocking staggering long-term portfolio growth. He didn't time the end of Watergate. He didn't need to. He just needed to be right about the enduring economic strength of the Washington Post. The psychological trap that Buffett sidestepped, and that most investors fall into, is a combination of recency bias and a phenomenon known as narrative-driven investing. Recency bias is our natural tendency to give greater importance to recent events than to historic ones. The investors selling Washington Post stock in 1973 were not thinking about the newspaper's 50-year history of dominance in its market. They were thinking about the threatening headlines from the Nixon administration that they read that morning. Their entire valuation of the company became anchored to the most recent, most frightening piece of information. The long-term, stable reality of the business's moat was mentally overwritten by the short-term, volatile political drama. This is a critical failure in the wealth management process, because it leads to a complete miscalculation of probabilities. The probability of the U.S. government wrongfully revoking the broadcast licenses of a major media company was, in reality, extremely low. But because of recency bias, the market began to price it as a near certainty. The drama of the story made the low probability outcome feel much more likely than it actually was. This is then supercharged by our brain's love for compelling narratives. Humans are story-driven creatures. We make sense of the world through stories, not spreadsheets. The story of brave newspaper versus corrupt president was an incredibly powerful, emotionally engaging narrative. The problem is that when we invest based on narratives, we often ignore the underlying economics. The market was so caught up in the political thriller that it forgot to do the boring work of analyzing the company's financial statements. A good story, whether positive or negative, can be a powerful hallucinogen for an investor, causing them to see a reality that doesn't actually exist in the numbers. Buffett's mind works differently. He is a master at divorcing the narrative from the business. He actively resists the pull of the story and forces his attention onto the economic engine. His process is a conscious effort to fight recency bias. He does this by focusing on long-term historical data. He would have looked at the post-circulation numbers, advertising revenues, and profit margins, not just for the last quarter, but for the last decade. This long-term perspective provides the context necessary to see the current crisis for what it is: a single, volatile data point in a much longer, much more stable trend. He is essentially using a deep well of historical data to dilute the emotional power of the recent news. Furthermore, he is fundamentally an economics-driven investor, not a narrative-driven one. He once said, "You can't buy what's popular and do well." This is another way of saying that you cannot invest in the story that everyone is already telling. By the time a story is popular, its financial implications are already reflected in the stock price. The real opportunity lies in finding businesses where the underlying economic reality is far better than the popular narrative surrounding it. The Washington Post in 1973 was the perfect example. The popular narrative was one of political risk and industry decline. The economic reality was one of monopoly power and gushing cash flows. To achieve this level of psychological discipline, an investor must train themselves to be a skeptic of all popular market narratives. When you hear a story about a company, good or bad, your first question should not be, "Is this story compelling?" but, "What do the numbers say?" This requires a deliberate shift from being a passive consumer of financial media to being an active and critical business analyst. You must learn to love the process of digging through financial documents, of understanding competitive advantages, and of calculating intrinsic value. This is the hard, often tedious work that insulates you from the emotionally captivating, but financially ruinous, stories that dominate the market's daily discourse. It is the only way to ensure your capital allocation decisions are based on the enduring realities of business, not the fleeting dramas of the news cycle. How can you, as a retail investor or an entrepreneur looking to allocate capital, systematically identify these great businesses amidst the noise? The blueprint is to create and diligently apply a durable competitive advantage checklist. This mental model forces you to look past the temporary headline and focus on the structural characteristics of the business that allow it to fend off competitors and earn high returns on capital over long periods. This is the very essence of value investing. The first item on your checklist should be to identify the specific type of economic moat the company possesses. There are several primary types. One is network effects, where the value of the service increases as more people use it, like with American Express cards or Facebook. Another is intangible assets, such as strong brand names like Coca-Cola or patents that protect a pharmaceutical drug. A third is cost advantages, where a company can produce its goods or services cheaper than its rivals, like Geico in insurance or Walmart in retail. A fourth is high switching costs, where it is too expensive or troublesome for a customer to move to a competitor, like the relationship a business has with its primary banking partner. Finally, there is efficient scale, where a market is effectively served by one or a very small number of companies, creating a natural monopoly, like a railroad or a utility or a major city newspaper in the 1970s. For any company you analyze, you must be able to clearly identify and articulate which of these moats it possesses and why. If you can't, it's likely not a great company and you should move on, no matter how cheap the stock seems. The second item on your checklist is to assess the durability of that moat. A moat is useless if it's shrinking. You must ask, is this competitive advantage getting stronger or weaker over time? A newspaper's moat in 1973 was formidable. A newspaper's moat today, in the age of the internet, has been almost completely destroyed. This requires you to think critically about technological changes, competitive dynamics, and shifting consumer behaviors. A great business must not only have a moat, but a moat that is stable or widening. The third checklist item is to analyze the company's financial health, specifically its balance sheet and cash flow statement. A great company can weather a storm. A leveraged company can sink. Look for low levels of debt relative to equity and earnings. A company with a fortress balance sheet has the staying power to survive a temporary crisis and can even use the crisis to acquire weaker rivals. Then, look at the cash flow statement. Does the business consistently generate more cash than it consumes? Free cash flow is the lifeblood of a business. It's the money left over, after all expenses and investments, that can be used to pay dividends, buy back stock, or expand the business. A history of strong, consistent free cash flow is a hallmark of a high-quality enterprise. The fourth item is to evaluate the management team. Are they rational capital allocators? A great management team thinks like owners. They don't overpay for acquisitions, they repurchase shares when the stock is undervalued, and they invest in projects that generate high rates of return. Read the CEO's annual letter to shareholders. Do they speak candidly about mistakes? Do they focus on long-term value creation rather than short-term stock price movements? Buffett saw in Katharine Graham a publisher of immense integrity who is focused on the long-term health of her newspaper, not on placating Wall Street or the White House. The final item on the checklist is to demand a price that gives you a margin of safety. Once you've confirmed the company has a durable moat, strong financials, and good management, you must then determine what it's worth. You can use various valuation methods, like a discounted cash flow analysis, or looking at price-to-earnings ratios relative to history. Whatever method you use, the goal is to arrive at a conservative estimate of intrinsic value. Then, as with the headline stress test, you wait for a moment of market panic to offer you a price that is significantly below that value. By rigorously applying this 5-part checklist, you create a systematic process for stock picking that is immune to emotional decision-making. You are no longer guessing. You are evaluating businesses based on a clear set of criteria for greatness. This allows you to act with confidence when a company like the Washington Post is surrounded by fear, because your conviction is not based on a hope that the headlines will get better, but on a deep analytical understanding of the business's enduring economic power. This is the framework that allows you to find those rare opportunities for transformational portfolio growth. The path of the 99% is littered with the wreckage of investors who confused a temporary problem with a broken business. They are the antithesis of the discerning analyst. They practice what can be called headline momentum investing. Their primary analytical tool is the direction and tone of the news. When the news is good, they buy. When the news is bad, they sell. They make no distinction between the quality of the underlying assets. A prime example of this folly can be seen in the aftermath of almost any major industrial accident or corporate scandal. Consider the 2010 Deepwater Horizon oil spill, a catastrophic event for BP. The headlines were apocalyptic. The environmental damage was immense. The political outrage was deafening, and the potential financial liabilities seemed infinite. The company's stock price was cut in half in a matter of weeks. The quote, headline momentum investor saw this and concluded that BP was finished. They saw an endless stream of negative news and sold their shares in a panic, or avoided the stock entirely, convinced it was heading to zero. They made no attempt to separate the event from the company's long-term business model. They failed to ask the critical questions from our checklist. Did BP have a durable competitive advantage? Yes, as one of the world's largest integrated oil and gas companies, it had immense scale, logistical networks, and valuable reserves. A powerful moat in the energy sector. Did it have the financial strength to survive? A deep dive into its balance sheet and cash flow statements would have shown that while the liabilities would be enormous, the company generated tens of billions of dollars in cash flow annually and could afford the cleanup and legal costs over time, albeit with significant pain. Was the problem temporary or permanent? As horrific as the spill was, it was a one-time operational disaster, not a permanent impairment of the world's demand for oil or BP's ability to extract and sell it. The contrarian investor applying the checklist would have seen a great company facing a massive but survivable problem. They would have attempted to quantify the total potential liability, and, seeing that the market was pricing in a scenario far worse than the likely outcome, would have started buying the stock at its point of maximum pessimism. In the years that followed, BP stock, while never reaching its pre-spill highs due to the massive debt taken on, still generated enormous returns for those who bought near the bottom. The headline momentum investor, on the other hand, likely sold at the bottom, locking in a devastating loss. They confused a terrible event with a terrible investment. This mistake is repeated constantly. An E. coli outbreak hits a popular restaurant chain. The stock plummets. The headline momentum investor sells, fearing the brand is permanently damaged. The discerning analyst checks to see if the company's moat, its brand and loyal customer base, is likely to recover, as it almost always does, and sees a buying opportunity. A pharmaceutical company's new drug fails a late-stage trial. The stock collapses. The headline investor sees only failure. The analyst looks at the company's pipeline of other drugs, its patent portfolio, and its balance sheet to determine if the market's reaction to one setback is pricing the entire enterprise for disaster. The fundamental error of the 99% is a failure of imagination. They cannot imagine a future where the current bad news is no longer the most important fact about the company. Their thinking is trapped in the present moment of crisis. The successful contrarian, by contrast, lives in the future. Their entire stock analysis process is designed to answer the question, what will this business look like in 5 or 10 years, after this crisis is a distant memory? By focusing on the durable, long-term characteristics of the business, they are able to look through the temporary fog of fear and see the enduring value on the other side. The path of the 99% is to be perpetually whipsawed by the news cycle, a guaranteed strategy for wealth destruction. The direct financial connection between identifying great businesses and achieving financial freedom lies in the concept of compounding quality. Investing is not just about buying cheap things. It's about buying great things cheaply. The great part of that equation is what generates wealth over the long term. The cheaply part is what turbocharges your returns at the beginning. A great business, one with a durable competitive advantage, is a machine for creating shareholder value year after year. Let's quantify this. A key metric to look at is return on invested capital, or ROIC. This number tells you how much profit a company generates for every dollar of capital invested in the business. A mediocre company might generate an ROIC of 6 to 8%, barely above its cost of capital. A truly great business, like the Washington Post in its heyday or a modern tech giant, can consistently generate an ROIC of 20%, 30%, or even more. This high ROIC is a direct financial manifestation of the company's economic moat. The moat protects the business from competition, allowing it to maintain high profit margins and efficiently deploy capital. When you buy a company with a high ROIC, you are harnessing a powerful compounding engine. Each year, the company retains some of its earnings and reinvests them back into the business at that high rate of return. This creates a virtuous cycle of value creation. A company that can consistently reinvest its earnings at 20% will see its intrinsic value grow at a similar rate over time. The stock price must eventually follow this growth in underlying value. This is the engine that turns a $10,000 investment into a $100,000 one over a decade. Now combine this with the contrarian's timing. When you buy this high ROIC business during a period of market panic, you get a double benefit. First, as we discussed before, you get the return from the price snapping back to its fair value as the fear subsides. Second, and more importantly for long-term wealth management, you get to ride the wave of that powerful internal compounding for years to come, but you bought into that wave at a discounted price. Let's use the Washington Post as a financial example. When Buffett was buying the company, the market valued it at $80 million. Let's say, for simplicity, its sustainable earning power was around $10 million per year. At that price, he was buying it at a price-to-earnings ratio of 8. However, Because of its monopoly position, the Post could reinvest a portion of those earnings back into its business and grow its future earnings at a high rate. The market, fixated on Watergate, was giving him not just a low multiple on current earnings, but also almost no credit for this future growth. The financial transformation comes from capturing both the re-rating of the multiple, as the P/E ratio expands from a fearful 8 to a more normal 15 or 20, and the underlying growth in earnings per share year after year. This is the 1-2 punch that creates 100-bagger returns. An investor who only looks for cheap stocks, low P/E ratios, but ignores the quality of the business, the ROIC, often falls into what's known as a value trap. They buy a company that looks statistically cheap, but it's cheap for a reason. It's a terrible business with no moat and low returns on capital. The stock price never goes up because the underlying business is stagnant or shrinking. By insisting on greatness first, a durable moat, and a high return on invested capital, you protect yourself from these value traps. The financial payoff of this pillar is therefore twofold. In the short to medium term, it gives you the confidence to buy during a crisis, knowing the business has the strength to survive. In the long term, it ensures that the assets you hold in your portfolio are high-quality compounders that create wealth for you while you sleep. This is the surest path to significant long-term portfolio growth and true financial freedom. We now arrive at the third pillar, which directly addresses the central thesis: you pay a very high price for a cheery consensus. This pillar is about understanding that by the time an investment is universally loved, comfortable, and celebrated, the opportunity for life-changing returns has already been arbitraged away. The real money in stock picking is made in the discomfort, in the uncertainty, and in the divergence of your opinion from the crowds. The foundational anecdote for this pillar is perhaps Buffett's most famous and, until recently, most questioned major investment, his foray into Apple. By 2016, Apple was already one of the largest and most successful companies in the world. It was not a small, obscure company like American Express in the 60s or a politically controversial one like the Washington Post in the 70s. It was a global behemoth. However, in 2016, a cloud of pessimism had gathered around it. The narrative, pushed heavily by Wall Street and the tech media, was that Apple's best days were behind it. The iPhone, the engine of its growth, was seen as a mature product. Sales had declined year over year for the first time. The worry was that Apple had lost its innovative spark after Steve Jobs. The consensus view was that it was no longer a growth company, but was morphing into a stodgy, slow-growing hardware manufacturer like IBM or Dell, destined for a future of low growth and compressing profit margins. The headlines were relentless. Peak iPhone is here. Apple's innovation engine has stalled. The great growth story is over. The stock, which had traded at over $130, fell below $90. The cheery consensus of years past had evaporated and been replaced by a consensus of doubt and fear. While the world was worried about the next quarter's iPhone sales, Warren Buffett and his team at Berkshire Hathaway started digging. They weren't looking at Apple as a tech company. They were analyzing it as a consumer products company with a massive, sticky ecosystem. What did they see? They saw a brand that commanded incredible loyalty, an intangible asset of immense value. They saw hundreds of millions of users locked into the Apple ecosystem of software and services, a system with incredibly high switching costs. An iPhone user was likely to buy an iPad, a Mac, and pay for services like iCloud and the App Store. This ecosystem was the real moat, and it was getting stronger, not weaker. They looked at the iPhone not as a piece of hardware, but as the indispensable centerpiece of a person's digital life. How much is that worth? Buffett famously asked himself how many people would refuse to give up their iPhone for $10,000. The answer, he concluded, was that most people would not. Yet the market capitalization of the company was pricing this indispensable product as if it were a disposable commodity. He saw that the market was fixated on the short-term replacement cycle of the phone, while completely undervaluing the long-term recurring revenue stream from the ecosystem it enabled. He concluded that the fear of peak iPhone was a massive overreaction that was obscuring the reality of Apple's fortress-like business model. Starting in 2016, Berkshire Hathaway began buying Apple stock, and they didn't just nibble, they bought with conviction, investing billions upon billions of dollars. Wall Street was stunned. Why was this famous technophobe, who had famously avoided tech stocks for his entire career, now making a massive bet on what they considered to be a fading hardware company? The consensus was that Buffett had lost his touch. He was buying when the story was negative, when the growth narrative was broken, and when the experts were all saying to stay away. He was paying the price of pessimism, which was a very, very low price. The rest, as they say, is history. The peak iPhone narrative proved to be spectacularly wrong. Apple's services business exploded, its profitability soared, and the stock embarked on one of the most incredible runs in market history, eventually becoming the world's first trillion-dollar, then $2 trillion company. Berkshire's investment in Apple has been the single most successful investment of Buffett's later career, generating over $100 billion in unrealized capital gains. It is the ultimate proof that even with the biggest, most well-known companies in the world, the principle holds true. The moment of maximum financial opportunity is not when the news is great. It's when a great company is temporarily abandoned by the consensus. The psychological force at play here is one of the most powerful in human society: social proof. Social proof is the tendency to assume that the actions of others reflect the correct behavior for a given situation. If everyone is running out of a building, you don't stop to analyze the situation. You run too. If everyone is buying a particular stock, you assume they must know something you don't, and you feel a powerful urge to join them. This is the mechanism that inflates bubbles and creates market manias. The cheery consensus is social proof in its most potent financial form. When every analyst has a buy rating on a stock, when financial news anchors celebrate its every move, and when your friends are all getting rich from it, the social pressure to conform and buy becomes immense. To not own the stock feels like you are actively choosing to be wrong, to be left out. It feels foolish. Buffett's psychological genius lies in his ability to invert this. He understands that in investing, social proof is a contrarian indicator. If everyone agrees that an investment is a surefire winner, it means the price has already been bid up to a level that reflects that universal optimism. The potential for outsized returns is gone. The risk-reward has become skewed unfavorably. He famously said, "You can't buy what is popular and do well." He actively seeks out situations where the social proof is negative. He is attracted to the stocks that people hate, that analysts have downgraded, and that the media has written off. He understands that this negative social proof is what creates the depressed stock price, the margin of safety, and the opportunity for massive portfolio growth. When he was buying Apple in 2016, the social proof was overwhelmingly negative for a tech investor. The consensus was that the great growth story was over. By defying that consensus, he was able to acquire his massive stake at an average price that was a fraction of its future value. To cultivate this mindset, you must learn to be psychologically comfortable with being lonely. You must be able to hold a view that is different from the majority and not be swayed by their confidence or their ridicule. This is extraordinarily difficult. Our brains are wired for social cohesion. Being part of the herd provides a feeling of safety and validation. Standing apart from it triggers feelings of anxiety and self-doubt. This is why true contrarian investing is so rare and so profitable. Buffett has built his entire life and organization in a way that insulates him from the psychological pressures of Wall Street. By operating out of Omaha, Nebraska, far from the daily noise and groupthink of New York, he creates a physical and mental distance that allows him to think clearly and independently. He reads voraciously, but he is not glued to a stock ticker or the emotional chatter of financial television. He is running his own race, based on his own analysis. As a retail investor, you can create your own Omaha. You can choose to limit your exposure to the daily hype cycle of the financial media. You can build a disciplined, analytical process and trust it, even when it leads you to a conclusion that is unpopular. You must train your brain to see a widespread, cheery consensus not as a green light, but as a yellow warning light. And conversely, you must learn to see a chorus of negativity and doubt surrounding a great company not as a red stop sign, but as a green light to start doing your homework. It is a fundamental rewiring of your financial instincts, away from the comfort of the herd and toward the lonely but vastly more profitable path of independent thought. To turn this psychological insight into a practical and repeatable trading strategy, you need a mental model for systematically challenging the prevailing wisdom. We can call this the consensus inversion framework. It's a simple yet powerful three-step process for stress testing any popular market narrative and finding the hidden opportunities within it. Step 1 is to explicitly identify and articulate the current consensus view. You cannot challenge a view you haven't clearly defined. For any stock or market, ask yourself, what is the dominant story that everyone believes right now? You should be able to write it down in 1 or 2 sentences. For Apple in 2016, the consensus was, Apple is a one-product company. The iPhone has peaked, and its future is one of slow growth and declining margins. For oil stocks during a price crash, the consensus might be, the world is moving to green energy. Demand for oil is in permanent decline, and these companies are going to zero. For a retailer facing the threat of e-commerce, it might be, Amazon will destroy them, their stores are worthless, and bankruptcy is inevitable. You must be precise. This is the story that is already priced into the stock. Step 2 is the inversion. You take the consensus view, and you rigorously explore the exact opposite case. You must become a devil's advocate for your own portfolio. Assume the consensus is completely wrong. What would have to be true for the opposite to happen? This is not about wishful thinking. It is about a disciplined search for disconfirming evidence. For Apple, the inversion would sound like this. What if the iPhone isn't just a product, but the gateway to a powerful and growing ecosystem of services? What if the brand's loyalty allows it to maintain high margins and pricing power? What if the installed base of 1 billion devices is a massive, undervalued asset that will generate recurring revenue for decades? You are forced to look for data points that the consensus is ignoring. You would start looking at the growth rate of the App Store, the number of paid subscriptions, and customer satisfaction surveys. You are actively searching for the bull case that the market has forgotten. Step 3 is to assess the asymmetry of the potential outcomes. This is the crucial step for any value investing decision. Given the current stock price, which reflects the pessimistic consensus, what is your potential upside if the inversion case proves to be true? And what is your potential downside if the consensus is right? In a great contrarian investment, you will find a skewed or asymmetric payoff. With Apple in 2016, the downside seemed limited. If the consensus was right, and it became a slow-growing hardware company, it was still a fantastically profitable business that was trading at a cheap price. It would likely become a solid, if unspectacular, investment, paying a dividend and chugging along. The stock might not go up much, but a permanent loss of capital seemed unlikely. However, the upside was enormous. If the inversion case was right, and the market was undervaluing the ecosystem, then the stock was not just a little cheap, it was ridiculously cheap. The potential for the stock to double, triple, or more was very real. This is the holy grail for a contrarian investor. Heads, I win. Tails, I don't lose much. You are making a bet where the potential reward vastly outweighs the potential risk. By applying this consensus inversion framework, you force yourself to move beyond the lazy, first-level thinking that dominates the market. First-level thinking says the company is facing problems, I should sell. Second-level thinking, which this framework cultivates, says the company is facing problems, everyone knows it, and it's already priced into the stock. Now, what is the market missing? What are the chances the problems are not as bad as everyone thinks, and what does that mean for the stock's future potential? This disciplined process of questioning the crowd is what separates the amateur from the professional. It is the analytical engine that allows you to confidently buy when the consensus is cheery about selling, and it is the key to unlocking the kind of market-beating returns that lead to true wealth management success. The antithesis to this disciplined contrarian approach is the investor who is a slave to the story stock. This is the 99% who perpetually chase narratives, especially those of disruptive innovation and boundless growth, paying any price to be part of the next big thing. Their downfall is not that they invest in bad ideas, often the ideas are brilliant, but that they pay a price for them that is completely detached from any sober assessment of future cash flows. The dot-com bubble of the late 1990s is the ultimate cautionary tale. The consensus narrative was intoxicating and, in many ways, correct. The internet was going to change the world. It was a technological revolution on par with the printing press or the steam engine. This narrative created a cheery consensus of unprecedented scale. Any company with a .com in its name was hailed as a visionary, and its stock price soared to astronomical levels, completely untethered from traditional metrics like revenue or earnings. Investors, caught up in the mania and fueled by social proof, abandoned all valuation discipline. They bought into companies that had no profits, no clear business model, and in some cases, no revenue. They were not buying businesses. They were buying lottery tickets based on a compelling story. The price they paid for this cheery consensus was infinite, in the sense that the price-to-earnings ratios were undefined because there were no earnings. They justified these valuations with new paradigm thinking, arguing that old metrics didn't apply in this new economy. This is a classic sign of a market top, the belief that this time is different. When a company like Pets.com, which sold pet supplies online, could achieve a market capitalization in the hundreds of millions of dollars while losing money on every sale, you know that the consensus has become dangerously cheerful. The inevitable crash was brutal. When the narrative broke and the tide of capital went out, it was revealed that most of these companies were swimming naked. Stock prices collapsed by 90%, 95%, or even 100%. Fortunes were wiped out. The investors who had paid the highest prices at the peak of the euphoria suffered the most catastrophic losses. The lesson is not that the internet was a bad bet. It was a phenomenal bet. The lesson is that even a correct long-term thesis can lead to financial ruin if you pay too high a price for it. An investor who bought Amazon during the bubble saw its stock price collapse by over 90% in the aftermath. While the company ultimately survived and thrived, that investor had to endure more than a decade of being underwater on their investment. Many, if not most, would have panicked and sold near the bottom, locking in a devastating loss. Contrast this with the contrarian. During the height of the dot-com mania, Warren Buffett was openly mocked. He was called a dinosaur, a relic of an old economy who didn't get it. He refused to participate in the frenzy because he could not value these companies with any degree of certainty, and he certainly wasn't going to pay the insane prices the market was demanding. He was willing to look foolish in the short term to avoid permanent capital loss in the long term. His discipline was rewarded when the bubble burst, and his value-oriented approach came roaring back into favor. The path of the 99% is to fall in love with the story and ignore the price. The path of the contrarian is to fall in love with the price and be skeptical of the story. The story stock investor outsources their thinking to the crowd, hoping the narrative will carry them to riches. The value investor does their own work, demanding a margin of safety, knowing that the price you pay is the ultimate determinant of your return. The failure to heed this lesson is why most retail investors dramatically underperform the market over time, chasing one hot story after another, always arriving late to the party and suffering through the inevitable hangover. The financial connection between avoiding the cheery consensus and building long-term wealth is one of the most fundamental laws of investing. Valuation matters. More specifically, the price-to-earnings PE ratio you pay for a stock has a direct and powerful impact on your future returns. The PE ratio is a simple metric. It's the stock's current price divided by its earnings per share. It tells you how many dollars you are paying for $1 of the company's current annual profit. When there is a cheery consensus around a stock, its P/E ratio gets bid up to very high levels. Investors are so optimistic about the future that they are willing to pay 30, 40, 50, or even 100 times the company's current earnings. Let's quantify the impact of this. Imagine two companies, Company A and Company B. Both are great businesses that are expected to grow their earnings by 10% per year for the foreseeable future. However, Company A is a popular glamour stock, and its cheery consensus has driven its P/E ratio to 40. Company B is a high-quality but currently out-of-favor company, and its pessimistic consensus has left it with a P/E ratio of 10. You invest $10,000 in each. In Company A, your $10,000 buys you $250 of annual earnings, 10,040ths. In Company B, your same $10,000 buys you $1,000 of annual earnings, 10,010ths. From day one, you own 4 times the earnings power by choosing the unpopular stock. Now let's look forward 5 years. Both companies have successfully grown their earnings by 10% annually. The earnings you own in Company A have grown to about $403. The earnings you own in Company B have grown to about $1,610. Now, let's assume the market comes to its senses, and both companies are now valued at a more reasonable P/E ratio of 20. Your investment in Company A is now worth about $8,060, 403*20. You have lost money, despite investing in a great company that grew its earnings. Why? Because the contraction of the P/E ratio from a euphoric 40 to a normal 20 more than offset the company's business growth. This is the financial danger of paying for a cheery consensus. Now look at Company B. Your investment is now worth $32,200. 610*20. You have more than tripled your money. You benefited from both the growth in the company's earnings and the massive tailwind of the P/E ratio expanding from a pessimistic 10 to a normal 20. This is the immense financial power of buying when there is no cheery consensus. The price you pay acts as either a headwind or a tailwind to your future returns. A high starting P/E is a powerful headwind that you must overcome just to break even. A low starting P/E is a powerful tailwind that amplifies the returns you get from the business's own growth. Buffett's purchase of Apple is a perfect real-world example. He was buying the stock when its P/E ratio had fallen to around 10, a level usually reserved for dying businesses. The market was pricing it for zero growth. As Apple continued to grow and the market's perception changed, the P/E ratio expanded significantly to 25 or 30. This P/E expansion was a huge component of Berkshire's massive capital gains, on top of the already impressive growth of Apple's earnings. This is the direct, quantifiable financial advantage that a contrarian trading strategy provides. By training yourself to investigate companies that are disliked or ignored, you are systematically tilting the mathematical odds of success in your favor. You are ensuring that you start every investment with a tailwind at your back, rather than a gale force wind in your face. This discipline, applied consistently over an investing lifetime, is the difference between mediocre portfolio growth and the kind of compounding that builds true, lasting financial freedom. The fourth pillar is arguably the most difficult to master, for it requires not action, but a profound and disciplined inaction. It is the cultivation of patience, the understanding that once you have purchased a great company at a bargain price, your work is not finished. You must now endure the waiting period, the time it takes for the cloud of bad news to dissipate and for the market to recognize the value you saw. This is the principle of time arbitrage, exploiting the market's obsession with short-term results by focusing on a long-term horizon that few others possess. The foundational anecdote for this pillar involves one of Buffett's most iconic and long-standing investments, the Coca-Cola Company. The story begins not with a scandal or a specific piece of bad news, but with a market-wide panic. On October 19, 1987, a day that came to be known as Black Monday, the Dow Jones Industrial Average plummeted by nearly 23% in a single trading session. It was the largest one-day percentage drop in the index's history. The fear was electric. Investors, terrified of a repeat of the Great Depression, were dumping stocks indiscriminately. The narrative was that the bull market was over and a deep recession was imminent. In the months following the crash, the pessimism lingered. The consensus was to be cautious, to stay in cash, to wait and see. In this environment of fear and uncertainty, Warren Buffett went shopping. He famously quipped that the crash was a good thing, as it was like his favorite hamburger going on sale. One of the companies he analyzed with renewed interest was Coca-Cola. Coke in 1988 was a dominant global brand, but it was not without its own clouds. Just a few years earlier, it had suffered the massive public relations disaster of New Coke, a failed attempt to change its iconic formula. While the company had reversed course, the incident left a scar and created a perception that management might be capable of fumbling its golden goose. Furthermore, the company's stock had been a rather mediocre performer for many years prior. It was seen as a solid but boring blue-chip company. After the crash, Buffett saw his opportunity. He looked past the market panic and the lingering memory of the New Coke fiasco. He applied his checklist. Did Coke have a durable competitive advantage? Absolutely. It had arguably the most powerful brand name in the world, a global distribution network that was virtually impossible to replicate, and a simple product that billions of people enjoyed every day. Its moat was wide and deep. He saw a business with incredible economics, a high return on capital that required very little incremental investment to grow. He famously stated that you could give him $100 billion and task him with taking away Coke's market leadership, and he couldn't do it. Between 1988 and 1989, Berkshire Hathaway invested over $1 billion to acquire a massive stake in Coca-Cola. At the time, it was the largest single investment Berkshire had ever made. But the key to this story is not just the buying, it's the holding. Buffett didn't buy Coke in 1988 hoping for a quick pop in 1989. He bought it with the intention of holding it for years, if not decades. He had to sit through periods where the market was flat, where analysts questioned the company's growth prospects, and where other, flashier stocks were capturing the headlines. He had to have the patience to let his thesis play out, to allow the power of Coke's global compounding engine to work its magic. He held through the recession of the early 1990s. He held through the dot-com bubble when his steadfastness in owning old economy stocks like Coke made him look like a relic. He just held. And what was the result? That $1 billion investment has since paid Berkshire billions upon billions of dollars in dividends alone, far more than its original cost. The value of the stock itself has grown more than tenfold. It became a foundational pillar of Berkshire's wealth, a testament to the power of buying a wonderful business at a fair price and then having the patience to do nothing. The lesson is that the big money is not made in the buying or the selling, but in the waiting. Buffett's time arbitrage was his willingness to operate on a 5 to 10 year time frame in a market that is obsessed with the next 5 to 10 minutes. This patience is the rarest and most valuable commodity in the world of wealth management. The underlying psychological principle that makes patience so difficult and therefore so profitable is a cognitive bias known as hyperbolic discounting, also referred to as present bias. This is our brain's innate tendency to prefer smaller, immediate rewards over larger, later rewards. We are wired to value the present far more than the future. A person is offered the choice between $100 today or $110 in a week. Most people will choose the $100 today, even though a 10% return in 1 week is an astronomical risk-free gain. The desire for immediate gratification is overwhelmingly powerful. This is an evolutionary trait that served our ancestors well. In a world of scarcity and immediate threats, it made sense to take the guaranteed meal today, rather than hope for a bigger meal tomorrow that might never materialize. In the world of modern investing, this same instinct is a catastrophic bug in our mental software. The stock market is a constant temptation machine, preying on our present bias. It provides a continuous stream of feedback, red and green numbers flashing on a screen, that encourages constant action. The thrill of a quick profit from a short-term trade provides a dopamine hit, a small, immediate reward. The process of buying a great company and holding it for 10 years offers no such immediate gratification. It is a long, slow, and often boring process. There are no daily victories to celebrate. Your brain, craving that immediate feedback, screams at you to do something. This is why so many retail investors become traders. They can't stand the quiet inaction of long-term ownership. They feel compelled to check their portfolio constantly, to react to every news story, to sell a winner to lock in a small gain, or to sell a loser to end the psychological pain. Hyperbolic discounting also explains why investors find it so hard to sit through market downturns. The immediate pain of seeing their portfolio value decline feels far more potent than the abstract, distant promise of a future recovery and long-term growth. The desire to end the present pain by selling becomes almost irresistible. Buffett's entire operational philosophy is a rebellion against hyperbolic discounting. He has structured his life to maximize his ability to think long-term. He famously says his favorite holding period is forever. This is not just a clever line. It is a profound psychological commitment to overcoming present bias. He is not looking for the immediate gratification of a stock price tick. He is focused on the long-term accumulation of business value. He understands that the real wealth is not created by the frantic activity of the market, but by the slow, patient compounding of earnings within the great businesses he owns. To cultivate this patience, an investor must create systems and mindsets that short-circuit their brain's craving for immediate rewards. This can include things like not checking your portfolio every day, setting calendar reminders to review your investments only once a quarter, and, most importantly, deeply understanding the businesses you own. When you see yourself not as an owner of a flickering stock symbol, but as a part owner of a real, tangible business, it becomes easier to ignore the short-term noise. You wouldn't sell your share in a successful local business you owned just because the local economy had a bad month. You would focus on its long-term prospects. Applying this same owner's mindset to your public stock holdings is the psychological key to unlocking the power of patience. It is the only way to escape the tyranny of hyperbolic discounting and align your actions with the long-term strategy of compounding wealth. How do you translate this lofty ideal of patience into a concrete, actionable mental model? The blueprint for this is what we can call the 5-year test. It is a simple, yet profoundly effective discipline to force a long-term perspective on every investment decision you make. Before you purchase a single share of any company, you must be able to perform this exercise. Step 1 is to write down your investment thesis on a single piece of paper. This is not a complex financial model, but a clear, simple explanation in plain English of why you are buying this company. It should answer 3 questions. What is the company's durable competitive advantage? Why is it currently undervalued by the market? What specific catalysts or long-term trends will cause the market to eventually recognize its true value? Your thesis for Coca-Cola in 1988 might have been, Coca-Cola has the world's most valuable brand and an unparalleled global distribution network, creating a massive economic moat. The market is currently undervaluing it due to the recent market crash and general pessimism. Over the next 5 to 10 years, its continued international expansion and pricing power will drive significant earnings growth, which the market will eventually have to recognize. If you cannot articulate your reason for buying in simple, clear terms, you have not done enough research and should not invest. Step 2 is to take this piece of paper, fold it up, and put it in a physical envelope. On the outside of the envelope, write the name of the company and today's date. Then, and this is the most critical part, you must imagine that you are going to put this envelope in a safe, and you will not be allowed to open it or sell the stock for 5 full years. This is a thought experiment, but a powerful one. Ask yourself, based on the thesis I have just written, would I be comfortable and confident making this investment under these conditions? Would I be able to sleep at night for 5 years without looking at the stock price, trusting that the underlying business is strong enough to weather any storms and grow in value over that period? This single question acts as a powerful filter. It immediately disqualifies speculative short-term trades and hot tips. It forces you to think like a true business owner, not a gambler. If the thought of being locked in for 5 years terrifies you, it's a clear signal that your conviction in the long-term quality of the business is weak, and you should not proceed. Step 3 is to actually keep the thesis. Whether you do this physically or digitally, it's crucial to have a record of your thinking at the moment you made the investment. This serves as an anchor of rationality. During the inevitable periods of market panic or when the stock is underperforming, your emotions will be running high. You will be tempted to sell. At these moments, your discipline is to go back and reread your original calmly written thesis. Has anything fundamentally changed about the business that invalidates your original points? Has Coca-Cola's brand suddenly lost its power? Has its distribution network collapsed? 99% of the time, the answer will be no. The only thing that has changed is the stock price and the market's mood. By regrounding yourself in your original long-term logic, you give yourself the psychological strength to ignore the short-term noise and stick with your plan. The 5-year test is a pre-commitment device. It forces you to adopt a long-term mindset from the very beginning. It prevents you from making emotional decisions in the heat of the moment. For entrepreneurs, this is akin to developing a 5-year business plan. You don't abandon the plan because of one bad quarter. You stick to the long-term strategy. This model instills that same level of strategic patience in your approach to the stock market, transforming it from a casino of flashing lights into a venue for long-term capital allocation. This is the practical tool for implementing Buffett's time arbitrage advantage. The antithesis of the patient, long-term investor is the hyperactive trader, the person who represents the 99% of market participants caught in a ceaseless whirlwind of activity. Their portfolio is not a curated collection of businesses, but a revolving door of ticker symbols. Their philosophy is rooted in the mistaken belief that more activity equals better results. The day trader is the ultimate embodiment of this flawed approach. They wake up before the market opens, scanning pre-market movers and news headlines, looking for a stock they can ride for a few hours, or even a few minutes. Their decisions are based not on a deep understanding of business fundamentals, but on chart patterns, technical indicators, and the fleeting momentum of the day's hot stock. They are trying to predict the unpredictable, the short-term emotional whims of millions of other market participants. They buy a stock because it's breaking out and sell it moments later because a squiggly line on a chart crossed another squiggly line. They are engaged in a zero-sum game, or more accurately, a negative-sum game, after accounting for commissions and taxes. They are trying to outsmart algorithms and high-frequency trading firms that can execute millions of trades in the blink of an eye. It is a game that is almost impossible for a retail investor to win consistently. The hyperactive trader is a slave to hyperbolic discounting. They cannot tolerate the idea of waiting years for a return. They need the instant gratification of a closed trade, the dopamine rush of a small win. This constant need for action leads to a number of guaranteed wealth-destroying behaviors. First, it racks up enormous transaction costs. Every buy and every sell nibbles away at their capital through commissions and bid-ask spreads. Second, it creates a massive tax burden. Any gains on stocks held for less than a year are taxed at short-term capital gains rates, which are equivalent to ordinary income tax rates and are significantly higher than the preferential long-term capital gains rates. A long-term investor might pay a 15% or 20% tax on their gains, while a hyperactive trader could be paying 37% or more. They are giving a huge chunk of any potential winnings directly to the government. But the most damaging aspect of this approach is that it ensures the investor will never benefit from the true engine of wealth creation, the power of business compounding. The hyperactive trader who bought Coca-Cola in 1988 would have sold it a few weeks later for a 5% gain, feeling like a genius. They would have missed the subsequent 10,000% return that accrued to the patient owner. They are so focused on harvesting the small fruits that they never allow the tree to grow. This mindset is not limited to day traders. It affects many long-term investors as well. They buy a stock with good intentions, but after a few months of it going nowhere, their patience wears thin. They see another stock that is soaring, and the fear of missing out becomes unbearable. They sell their high-quality, boring company to chase the hot, exciting one, often just as the hot stock is about to peak. This constant portfolio churning, this activity for activity's sake, is a surefire recipe for underperformance. It is the very definition of working hard instead of working smart. The path of the 99% is one of constant motion, driven by anxiety and the desire for quick results. The path of the 1% is one of deliberate, patient, and often boring inaction, rooted in the deep confidence that comes from owning wonderful businesses for the long haul. The direct financial connection between patience and massive wealth creation is one of the most powerful forces in the universe, the magic of compounding, amplified by tax efficiency. The numbers behind this are not just impressive, they are life-altering. Let's start with the compounding. Imagine you invest $10,000 and manage to earn a 15% annual return. If you are a hyperactive trader who pulls out your gains each year, after 30 years, you would have made a total profit of $45,000, $1,500 per year *30. This is not a bad outcome. However, if you are a patient, long-term investor who lets your gains ride and compound, that same $10,000 at the same 15% annual return will grow to over $662,000. It is not a linear progression, it is an exponential explosion. The majority of that growth happens in the later years. This is the quote-unquote compounding snowball that Buffett talks about. Patience is the only ingredient that allows that snowball to roll long enough to become gigantic. Every time you sell a stock prematurely, you are melting your snowball and starting over with a smaller one. Now let's layer on the enormous advantage of tax efficiency. This is a crucial, often overlooked, aspect of wealth management. Let's compare two investors. Investor A is the patient, long-term holder. Investor B is the active trader. Both invest $10,000 and are skilled enough to find investments that appreciate by 20% each year. Investor B, the trader, sells at the end of each year to lock in his gains and then reinvests. His 20% gain, $2,000 in year one, is taxed as a short-term capital gain. Let's assume a 35% tax rate. He pays $700 in taxes, leaving him with only $11,300 to reinvest. He repeats this process every year. Investor A, the long-term holder, does nothing. His $10,000 grows to $12,000 at the end of year one, but since he doesn't sell, he pays no tax. The full $12,000 remains invested and continues to compound. Let's fast forward 30 years. Investor B, the active trader, after paying taxes on his gains every single year, would see his $10,000 investment grow to approximately $270,000. An impressive result. However, Investor A, the patient holder, who allowed his investment to grow untaxed for 30 years, would see his portfolio grow to over $2,300,000. When he finally sells at the end of 30 years, he will pay a long-term capital gains tax, let's say 20%, on his profit. His after-tax amount would be close to $1,900,000. By simply being patient and deferring the tax bill, Investor A ends up with 7 times more money than the equally skilled active trader. This is the staggering financial power of tax-deferred compounding. Your greatest partner in building wealth is not a clever trading algorithm. It is the U.S. tax code's preferential treatment of long-term capital gains. By being a long-term investor, you are essentially getting an interest-free loan from the government on your deferred tax liabilities, allowing a much larger sum of capital to work for you year after year. Patience, therefore, is not a passive virtue in investing. It is an active financial strategy. It is a deliberate choice to harness the twin engines of business compounding and tax efficiency. Every decision to hold rather than sell is a decision to keep your compounding snowball intact and to keep your tax partner at bay. This is how multi-generational wealth is built. It is not through frantic activity, but through the quiet, relentless, and financially profound power of waiting. We have arrived at the fifth and final pillar, the culmination of all the previous principles. It is the moment of decisive action. It is not enough to understand fear, identify quality, reject consensus, and cultivate patience. You must, at the critical moment, have the courage to act, to deploy significant capital, when every fiber of your being is screaming at you to seek safety. This is the ultimate expression of Buffett's famous dictum, "Be greedy when others are fearful." The foundational anecdote for this pillar is not a single investment, but a series of masterful strokes executed during the darkest days of the 2008 global financial crisis. In September and October of 2008, the global financial system was on the brink of complete collapse. Lehman Brothers had filed for bankruptcy. AIG, the world's largest insurer, had been bailed out by the government. The credit markets were frozen solid. There was a palpable, terrifying fear that the entire ATM network could shut down, that the world was plunging into a second Great Depression. The stock market was in a state of free fall. Panic was not just in the air, it was the air. In this moment of absolute maximum fear, when the world's most sophisticated financial players were paralyzed, Warren Buffett became the lender of last resort to capitalism itself. He didn't just buy a few beaten-down stocks. He made a series of massive company-saving investments that were as much a statement of confidence in the future of America as they were shrewd capital allocation. First, in late September 2008, he announced a $5 billion investment in Goldman Sachs, one of the most prestigious but beleaguered investment banks. This wasn't a simple stock purchase. It was a special deal for preferred stock that paid him a handsome 10% dividend per year. In addition, he received warrants that gave him the right to buy $5 billion of common stock at a fixed price in the future. He was not just buying a piece of the company, he was acting like a powerful, stabilizing bank. The news itself had a calming effect on the market, a Buffett seal of approval that signaled Goldman was going to survive. A few weeks later, he struck a similar deal with General Electric, another iconic American company whose financing arm was in deep trouble. He invested $3 billion in GE preferred stock, again with a 10% dividend and warrants. Then, a few years later in 2011, as fears of a European debt crisis were rattling the markets, he made a $5 billion investment in Bank of America under similar terms. Each of these actions was a masterclass in being greedy when others are fearful. He was not bottom-ticking the market. He was acting decisively while the panic was still raging. He was deploying billions of dollars into the very heart of the storm, the financial sector, which everyone else believed was on the verge of annihilation. He had the courage to do this because he had done the work prescribed by the first four pillars. He understood the anatomy of fear and knew it was causing a massive overreaction. Pillar 1. He had analyzed these companies and, despite their current troubles, believed in their long-term durable competitive advantages and their central role in the American economy. Pillar 2. He was acting in complete opposition to the deafening consensus that the financial world was ending. Pillar 3. And he was making these investments with a 5 to 10-year time horizon, exhibiting the patience to see them through the turmoil. Pillar 4. The financial crisis was the ultimate test, and Buffett's actions were the ultimate proof of his philosophy. He didn't just talk about being greedy when others were fearful. He backed up the truck and put billions of dollars of Berkshire's capital on the line, at the moment of maximum pessimism. The results were spectacular. Berkshire made billions in dividends from these preferred shares, getting paid handsomely to wait for the panic to subside. And the warrants he received became incredibly valuable as the stocks recovered, generating billions more in capital gains. These deals were not available to the average retail investor, but the principle is universal. The courage to act, to deploy your capital when fear is at its peak, is the final and most crucial step in transforming a market crisis from a threat into a once-in-a-generation opportunity for portfolio growth. The psychological principle that must be mastered to execute this final pillar is the ability to override our most primitive survival instinct, the fight-or-flight response. When faced with a terrifying threat, like a stock market in freefall, our amygdala, the brain's fear center, takes over. It floods our system with adrenaline and cortisol, preparing us to either fight the threat or flee from it. This is an amygdala hijack. Rational thought, which is handled by the slower, more energy-intensive prefrontal cortex, is shut down. In a financial crisis, the instinct to flee manifests as the overwhelming urge to sell everything and go to cash. The instinct to fight might manifest as frantic emotional trading. Neither is a rational response. The genius of Warren Buffett and other great contrarian investors is their ability to prevent the amygdala hijack. They have trained themselves to respond to the stimulus of market panic not with fear, but with curiosity and analysis. They have created a mental circuit breaker that allows their prefrontal cortex to stay in control. When others are panicking, their rational brain kicks in and says, "Wait a second, the price of this asset has just been cut in half. Is the underlying business half as valuable as it was yesterday, or is this an opportunity?" This is not something people are born with. It is a trained response, cultivated over decades of experience and disciplined practice. Buffett has seen numerous panics and crashes in his long career, in 1962, 1974, 1987, 2000, and 2008. He has learned through repetition that these moments of extreme fear are almost always the moments of extreme opportunity. This experience has forged neural pathways in his brain that associate market panic not with danger, but with the prospect of future riches. He has, in essence, classically conditioned himself to have the opposite emotional reaction to the crowd. While the crowd feels fear, he feels excitement. Another psychological tool he uses is preparation. Fear is most potent when we are surprised and unprepared. Buffett spends his time during calm markets studying businesses and building a wish list of great companies he would love to own at the right price. When a crisis hits and one of those companies gets hammered, he doesn't have to start his analysis from scratch in the middle of a panic. He has already done the work. He knows the business, he knows what it's worth, and he knows the price at which he wants to buy. This preparation allows him to act quickly and decisively, without emotion, because the decision was, in essence, already made during a calmer time. For a retail investor, this is a crucial lesson. The time to prepare for a crash is not during the crash. It is now, during periods of relative calm. Identify the great companies you want to own, study their businesses, and set your target prices. When the inevitable correction or crash comes, you won't be paralyzed by the amygdala hijack. You will have a plan. You can look at your pre-prepared list and say, "Company X is now trading at my target price. It is time to execute the plan." This transforms you from a victim of the panic into a predator, ready to seize the opportunities that the panic creates. It is the final step in rewiring your brain for contrarian success, replacing the primitive fear response with a calm, rational, and highly profitable course of action. To operationalize this principle of decisive action, you need a predefined framework, a checklist that guides you when the storm hits. This is the capital deployment checklist for crisis investing. It is the practical blueprint for being greedy when others are fearful. Step 1, to be completed during calm markets, is to create your watch list of wonderful businesses. This is a curated list of 10 to 20 companies that you have analyzed using the Durable Competitive Advantage checklist from Pillar 2. You understand their moats. You have reviewed their financials, and you admire their management. These are the only companies you will consider buying during a crisis. This prevents you from being distracted by cheap but low-quality companies that get swept up in the panic. Step 2, also during calm markets, is to set target buy prices for each company on your watch list. Based on your valuation work, you determine 3 price levels: start a position, add aggressively, and back up the truck. For example, for a stock you value at $100, you might set your start price at $70, your add price at $60, and your back up the truck price at $50. These are the prices at which you have predetermined the margin of safety is so large that the investment becomes incredibly attractive. Write these prices down. Step 3 is to build a cash reserve. You cannot be greedy when others are fearful if you have no cash. A crucial part of any wealth management strategy is to always have some portion of your portfolio in cash or cash equivalents, waiting to be deployed during a downturn. This is your dry powder. Having this cash on the sidelines not only gives you the financial ability to act, but also the psychological stability to endure a downturn in the rest of your portfolio, knowing you have the ammunition to take advantage of it. Step 4 is to wait. This is an extension of Pillar 4, patience. You must have the discipline not to chase the market when it's expensive, and to patiently wait for your prices to be hit. This can sometimes take years. During this time, you continue to learn about the companies on your watch list and refine your valuations. Step 5 is the execution phase, when the crisis hits and your prices are triggered. You must have the courage to follow your plan. This is the hardest part. The headlines will be terrifying. Your friends and family will tell you you're crazy. Every instinct will scream at you to wait, that it could go lower. You must trust the work you did during calmer times. You start buying at your first target price. If the stock continues to fall to your second price, you buy more, as planned. This systematic, tiered buying approach prevents you from trying to perfectly time the bottom, which is impossible. It ensures you are deploying capital at prices you have already deemed to be attractive. This checklist transforms crisis investing from an emotional, terrifying gamble into a disciplined, pre-planned business operation. It is the framework that allows you to act with the clarity and conviction of a Warren Buffett in 2008. You are not reacting to the panic. You are executing a strategy that was designed to exploit it. This is the final and most powerful tool in the contrarian investor's arsenal, the one that translates all the analysis and patience into tangible, life-changing capital gains. The antithesis, the path of the 99% during a crisis, is one of complete emotional paralysis followed by catastrophic capitulation. Their journey into the abyss begins with a lack of preparation. They have no watch list, no target prices, and often no cash reserve, because they were fully invested at the market top, captivated by the cheery consensus. When the market starts to fall, their first reaction is denial. They tell themselves it's a healthy correction and that it will bounce back quickly. They watch as their portfolio value declines by 10%, then 20%. The denial gives way to anxiety. They start checking the market constantly. They are glued to the financial news, which is filled with terrifying commentary and images of panicked traders on the stock exchange floor. Their amygdala is now fully engaged. As the market continues to plummet, down 30%, then 40%, the anxiety turns into sheer terror. They are not thinking about buying opportunities. They are consumed by the fear of losing everything, their entire net worth, their retirement, their financial security. It all feels like it's evaporating before their very eyes. They see the red numbers not as a discount, but as a confirmation of their impending doom. The thought of deploying more capital, of throwing good money after bad, seems utterly insane. All they want is for the pain to stop. Finally, they reach the point of capitulation. This is the moment of maximum pessimism, the point where all hope is lost. They can't take the psychological pressure anymore. They log into their brokerage account and they sell everything, converting their stocks to cash. The moment they click sell, they feel a wave of relief. The pain is over. They are safe in cash. They have just locked in a devastating, permanent loss of capital at the worst possible moment. They have sold their share of great American businesses at fire sale prices to the calm, prepared, contrarian investors on the other side of the trade. The final act of this tragedy unfolds during the recovery. The market eventually bottoms and begins to climb back, but the investor who capitulated is too traumatized to get back in. They are suffering from, quote, recency bias, convinced that the market will crash again. They wait for things to feel safe, for the news to turn positive, for the cheery consensus to return. By the time they finally feel confident enough to reinvest their cash, the market has already recovered most of its losses. They end up buying back into the market at prices that are often higher than where they sold, having endured the entire crash and missed the entire recovery. This cycle of being fully invested at the top, panicking and selling at the bottom, and waiting too long to get back in, is the single most efficient way to destroy wealth ever devised. It is the polar opposite of Buffett's approach. It is being fearful when others are fearful, and greedy only when others are also greedy. It is a guaranteed path to financial failure, a lifetime sentence of buying high and selling low, all because of a failure to prepare and a surrender to the primitive, and, in the world of investing, profoundly costly, instinct of fear. The direct financial connection of this final pillar is the most powerful of all. It is where the single greatest transfers of wealth occur. Acting decisively during a panic is how you acquire assets at prices that can generate not just 10% or 20% returns, but 10x, 20x, or even 100x returns over the long term. This is the financial engine that creates dynastic, generational wealth. Let's quantify the opportunity that a crisis presents. During a panic like 2008, it is not uncommon for the stocks of fundamentally sound great companies to fall by 50% or more. Consider a high-quality company whose stock falls from $100 to $30. For the investor paralyzed by fear, this represents a 70% loss. For the prepared contrarian, it represents the opportunity of a lifetime. When you buy that stock at $30 and it eventually recovers back to its intrinsic value of $100, your return is not 70%. It is over 233%. You have more than tripled your money simply by providing liquidity when no one else would. This is the crisis alpha that is only available to those who act. But the financial impact goes even deeper, as illustrated by Buffett's 2008 deals. Because he was one of the few people with both the capital and the courage to act, he was able to demand extraordinary terms. He didn't just buy common stock. He bought preferred stock with guaranteed high-yield dividends. This meant he was getting paid a 10% annual return just for his capital to be in the game. It was a massive cash flow stream that he received while he waited for the panic to subside. This is the financial equivalent of getting paid to wait for the storm to pass. Furthermore, he received warrants. Warrants are essentially long-term options that give the holder the right to buy stock at a fixed price. When Goldman Sachs stock recovered, the warrants Buffett held became immensely profitable. They provided an extra layer of equity-like upside with very little downside risk. This dividends plus warrant structure is a financial masterstroke. It creates a situation where your best-case scenario is a grand slam home run, and your worst-case scenario is still collecting a 10% annual dividend. It is the ultimate asymmetric bet, made possible only by acting as the calm center in a world of financial chaos. For the retail investor, while you may not get offered a special deal from Goldman Sachs, the principle translates. A crisis allows you to buy not just cheap stocks, but also the high-yield dividend streams they provide. A blue-chip stock that normally yields 2% might see its price fall so much that its dividend yield rises to 5% or 6%. By buying at that point, you are locking in a high, reliable income stream for years to come, on top of the massive potential for capital gains. The financial consequence of mastering this pillar is that you fundamentally change your relationship with market volatility. For the 99%, volatility is risk, a source of fear and loss. For the prepared 1%, volatility is opportunity. It is the mechanism that periodically delivers incredible bargain prices on wonderful businesses. By learning to be greedy when others are fearful, you turn the market's greatest perceived weakness into your single greatest strategic advantage. You will not only survive market crashes, you will emerge from them significantly wealthier than you were before. This is the final key that unlocks the highest level of investing success and ensures your journey toward financial freedom is not derailed, but accelerated by the inevitable storms to come. You have just navigated a deep and intensive journey through the core of Warren Buffett's contrarian philosophy. You have moved beyond the simple quotes and into the intricate mechanics of how he thinks. You have absorbed a powerful mental arsenal, a 5-part framework for turning market fear from your greatest enemy into your most profitable ally. You now possess a blueprint that the vast majority of investors will never understand. You know how to dissect fear, how to identify bulletproof businesses in a storm, how to price the cost of consensus, how to harness the profound power of patience, and most critically, how to act with decisive courage when it matters most. This is not just information, it is a fundamental upgrade to your financial operating system. You have acquired a tool that can quite literally change the trajectory of your financial life, a method for systematically finding and exploiting the opportunities that others, blinded by panic, are giving away. But here is the critical truth. This framework, as powerful as it is one crucial component in a much larger, interconnected system of thought. Buffett's mind is a latticework of mental models, and what you have just mastered is a vital, load-bearing pillar within that structure. Knowing when to buy is a superpower. But it is a superpower that must be paired with an equally deep understanding of what constitutes a truly wonderful business in the first place, or how to properly value its future cash flows, or how to assess the character and capital allocation skill of its management. Each principle reinforces the others, creating a structure of thought that is nearly indestructible. The journey to true mastery does not end here. You have built the foundation, but now you must build the rest of the fortress. The next piece of the map, the next link in this chain of mental models, is waiting for you. The video that is now appearing on your screen is not a random suggestion. It is the next step in this deliberate path. It contains the knowledge that connects to what you have just learned, that deepens it, and that makes it exponentially more powerful. The choice before you is a simple one. It is a choice that defines the difference between an amateur and a professional. The amateur learns one trick and is satisfied. The master understands that every piece of knowledge is a key that unlocks a new door, and they are relentless in their quest to collect every key, to complete their arsenal. The click you are about to make is not just a click to watch another video. It is a declaration of your intent to continue this journey, to complete your education, and to ascend to the level of financial thinking that few ever achieve. The choice of which you will become is in that next click. Complete your mental arsenal.